Welcome to Econverse. We're the show that really tries to unpack the economics behind things you use every day.
And today, we're looking at something probably sitting in your wallet right now.
The credit card. We're doing a deep dive.
Yeah, and for this, we've pulled together quite a bit. We've got explainers, the basic mechanics from places like Investopedia, Kiplinger, a pretty detailed academic paper from George Mason University looking at the economic theory, practical stuff from NerdWallet, Money Fit, Kiplinger again. So a real mix.
So this isn't just about, tap and go or reward points.
No.
Our goal here is to really understand the economic story. Why are they set up this way? What drives the companies? What drives us as users?
And maybe even a bit about the history, the regulation side of things.
Okay, so first principles. Economically speaking, what is a credit card?
At its heart, it's borrowing. Simple as that, really. You buy something now.
Mm-hmm.
The card issuer lends you the money short term, and you agree to pay it back later. Both Investopedia and Kiplinger make that fundamental point very clear.
Right, but it's not a blank check. There's a limit, the credit limit. How does that work?
Precisely. That limit, as Kiplinger points out, is the max you can borrow on that card.
And they decide that based on...
Well, they look at you,
Mm-hmm.
your financial picture, your credit history, definitely your credit score, income, basically how reliable you seem financially.
So better score, probably a higher limit.
Generally, yes. That's the idea.
Okay, so I use the card, I tap, I swipe, whatever. What's happening like in the background?
Ah, okay. So MoneyFit and Investopedia break this down. Your purchase info goes from the store's bank
Mm-hmm.
through a network of Visa, MasterCard, Amex, Discover.
The big names.
Exactly. To your card issuer, they do a quick check. Does this person have enough available credit? Is the account okay? And boom, approved and declined. Usually takes seconds.
Yeah, feels instant. But the economics get tricky when it comes to paying back, right? It's not free money.
No, definitely not. And the key, as Investopedia stresses, is when you pay the whole balance by the due date.
You're good.
You're usually good. No interest charges. But if you only pay part of it or none of it,
Then interest starts.
then interest starts piling up on whatever you didn't pay off. That's where the cost can really kick in.
Okay, that leads into how people actually use these cards. I saw the George Mason paper mentions two kinds of users, convenience users and revolvers.
Yes, and that's a really critical distinction for understanding the whole market. Convenience users, they basically treat it like a debit card.
Paying off every month.
Every month,
Yeah.
full balance. For them, it's a payment tool, no interest cost. Revolvers, though,
They carry a balance.
they carry a balance month to month, and they are the ones paying interest on that debt.
And that George Mason paper also looked at why cards became so popular beyond just delaying payment.
Yeah, it's interesting. They compare it to older methods, like cash. You hold cash, it actually loses value slowly because of inflation.
Right, inflation eats away at it.
Plus, you can't really use cash for everything these days. Online shopping, paying bills remotely, not practical.
Try mailing cash for your Netflix subscription. Yeah.
Exactly. And checks, well, they had their own issues. Risk of bouncing for you, risk for the merchant.
Uncertainty.
Right. Credit cards shift a lot of that immediate risk to the bank. Plus, the convenience factor we mentioned, automatic records of spending, and that grace period if you pay in full.
Okay, so lots of upsides, especially if you're a convenience user. But what about the costs for revolvers? The interest rates and fees? Let's dig into that.
Sure. So Investopedia notes that credit card APRs, the annual percentage rates, are generally higher than, say, a personal loan or a mortgage.
We've all seen those high numbers.
And like we said, interest gets charged on the balance you don't pay off. And here's the key thing.
Yeah.
If you carried a balance last month, you often lose the grace period this month.
Oh, so interest on new purchases starts right away.
It can start almost immediately. Yeah.
Yes.
It's not just on the old balance.
Ouch. And then there are fees on top of interest.
Oh, yes. Lots of potential fees. Late payment fees are common. Fees if you go over your credit limit. Fees for getting cash advances.
Right, using it like an ATM.
Exactly. Investopedia and Bits About Money detail these. They can really add up if you're not careful.
Now, that George Mason paper had an interesting point about interest rates being sticky, meaning they don't always move perfectly with, say, the rates the Fed sets. Why is that?
Yeah, that's quite insightful. The argument is that running a credit card operation involves significant costs beyond just the cost of borrowing the money they lend out.
Like what kind of costs?
Well, servicing millions of accounts, customer service, marketing to get new customers, processing all those transactions.
Okay.
These operating costs are a big chunk of the expense. So the interest rate they charge isn't just tied to the base cost of funds, like a mortgage might be more closely tied.
Yeah.
It makes the rate less volatile, maybe, less directly tied to those base rates.
That makes sense. And what about competition? There are so many cards, ads everywhere. How does that affect things?
Hugely important. The research suggests it's a very competitive market. Lots of banks, relatively easy for new players to enter
So they fight for customers.
fiercely, especially for customers who spend a lot and pay on time, or even those who revolve but are likely to pay back eventually. This competition has driven down things like annual fees
Yeah, you see fewer of those now.
and driven up the rewards programs, points, cashback, miles.
Trying to win your business.
Exactly. Bits About Money even mentions that sometimes, for the really desirable customers, the card itself might barely break even or even lose a bit of money.
Like a loss leader.
Kind of. The idea is to get that customer relationship, maybe sell them other profitable things later, like a mortgage or investments.
Wow. And people try to game this, right? Card surfing?
Uh-huh. The paper mentions that. People opening cards for those 0% introductory offers, then maybe transfer the balance or switch to another low-rate offer before the high regular rate kicks in. It's a strategy.
Needs discipline, though.
Absolutely. And issuers are getting smarter too, segmenting customers much more based on perceived risk, offering different rates to different people.
Okay. Now, a big reason people get credit cards, especially early on, is to build credit. Why is that so vital economically?
Right. Both Investopedia and MoneyFit really stress this.
Yeah.
Using a credit card responsibly,
Meaning paying on time.
paying on time, keeping balances low relative to your limits. That's a primary way you build a positive credit history, and that improves your credit score.
And the score isn't just for getting more cards, it impacts bigger things.
Oh, definitely. Your score affects whether you can get an auto loan, a mortgage, and critically, the interest rate you'll pay on those loans.
So a good score saves you real money.
Potentially thousands or even tens of thousands over the life of a big loan. And for people starting out or with damaged credit, MoneyFit mentions options like secured cards.
Where you put down a deposit.
Exactly. Or becoming an authorized user on someone else's card. Ways to get started or rebuild.
Let's look back a bit. The George Mason paper talked about usury laws. What were those?
So historically, states tried to cap interest rates. Usury laws set legal maximums for what lenders could charge.
Sounds like a good idea for consumers.
You'd think so, but the paper argues it had some unintended consequences.
Like what?
Well, if banks couldn't charge enough interest to cover their costs and risks, especially for riskier borrowers, they might just not lend. So less credit available overall.
Ah.
Or they'd find other ways to make money, like introducing or increasing annual fees. And it also led to more stores issuing their own cards, which sometimes weren't covered by the same state laws.
And then there was a big Supreme Court case, Marquette.
Yes, Marquette National Bank versus First of Omaha. That was huge. Essentially, the court said national banks could charge the interest rate allowed in their home state.
Regardless of where the customer lived.
Exactly.
Yeah.
Even if the customer's state had stricter usury laws.
So that basically blew the lid off state interest rate caps for many banks.
Pretty much. The analysis in the paper suggests this deregulation led to more competition. Banks based in states with high or no caps could lend nationwide, and ultimately more credit became available, arguably serving consumer demand better.
Okay, complex history there. So fast forward to today. We touched on this, but let's nail it down. How do the card companies make their money?
Right. Bits About Money lays out the main streams. First, net interest income. That's the interest paid by revolvers. It's a big piece.
Okay.
Second, interchange fees. Every time you swipe or tap, the merchant pays a small percentage fee that goes mostly to your bank, the issuer.
The fee the store pays.
Yep. Then you have other fees, late fees, over-limit fees, cash advance fees, etc.
We mentioned those.
And finally, sometimes marketing contributions, like an airline pays the bank to help promote a co-branded airline miles card.
Got it. So multiple streams. And you mentioned cross-subsidization before, that some cards might lose money.
Yeah, it's fascinating. A bank might offer a really generous travel rewards card that on its own doesn't make much profit, maybe even loses a bit because the rewards are so rich.
Why do that?
To attract a high-spending, maybe high-income customer. Once they have that customer using your card, maybe that customer will also get a mortgage from them, or open investment accounts, or use other banking services that are highly profitable.
So the card is the gateway.
Exactly. The card portfolio, and even the whole bank's customer base, involves this kind of internal balancing act.
Okay, one last area. For listeners maybe struggling with credit card debt, What's the practical advice from the sources?
Investopedia and MoneyFit have solid advice. First, obviously, try to limit adding more debt. Stop or drastically reduce using the cards.
Makes sense.
Then find extra money anywhere you can to throw at the debt. Focus on paying down one card at a time, usually either the one with the highest interest rate,
The avalanche method.
right, or sometimes the one with the smallest balance for a psychological win, the snowball method,
Right.
while making minimum payments on the others.
Okay.
Considering debt consolidation could also be an option. Maybe a lower interest personal loan to pay off all the cards, or a balance transfer to a 0% card. Though, be careful with transfer fees and the rate after the intro period.
And professional help.
Yeah. MoneyFit specifically mentions nonprofit credit counseling organizations. They can help you create a budget and a debt management plan. Definitely a resource worth looking into if you feel overwhelmed.
All right. So, wrapping up this deep dive, it's clear credit cards are way more than just plastic. They're this whole economic engine, really.
Totally. Built on borrowing, interest, fees, shaped by intense competition, regulation.
And understanding these forces hopefully helps you listening use them more effectively, make smarter choices.
Absolutely. And it makes you wonder, right, with all the changes in payments, digital wallets, buy now, pay later, crypto maybe someday,
Yeah.
how's this traditional credit card model going to change?
Yeah, what's the next evolution? What new economics, new behaviors will emerge?
It's a space to watch for sure.
Definitely something to think about. So, if any part of this discussion sparked your interest, maybe the history, the rewards game, debt strategies, we really encourage you to dig even deeper. Thanks for joining us on Econverse for this deep dive.